Welcome back to another video, guys. Today, I want to have a talk to you about the only stock that you'll ever need. Now, a little bit goes into this. The other night, my friend Big Dilly, he gave me a phone call and he said, I've done it, man. I've got some money put aside and I'm ready to get into this stock market thing. So we had a quick chat, and within probably about this 2-minute phone call, I had him signed up to an investing platform. We transferred some money. Boom, Big Dilly is in the market. But there was so much that I really couldn't explain in this phone call. And I thought to myself, what better way than to treat this whole video like exactly that, as if I'm having a phone call with a friend who's ready to get some money invested, start making some returns. And I guess that's exactly what this is. I want to explain to the beginners out there, I often forget, and I think everyone understands all these terms like, compounding interest and dividend yields and all this, but let's just break it down and take it back to the very beginning. I want to explain to you guys that are looking at getting into stocks and the share market how you can go about this. So if you're starting out, there's really only one place that I'd be putting my money, and that would be the S&P 500. Now, of course, to do this, you're going to need a brokerage platform, and I'll explain what the S&P 500 is in a minute, but you need a platform. So if you're in Australia, I know the big four banks all have their own share investing platform, and obviously do some research, find out who's cheapest, who's insured, who's got the least amount of money on trades. I myself use ComSec. It's just because I bank with the Commonwealth Bank. It's easier for tax time. Everything's all there. But what exactly is the S&P 500? Well, Standard & Poor's 500 is what that stands for. And basically, it is the largest 500 American blue chip companies on the market. So it's basically the American market. Now, you might be asking yourself, okay, but why is it so good? Or why do I want to put it just in that? And essentially, that's because over the last 100-year period, if you break it down on an average, per year, we've seen upwards of 10% returns per year. Now, I'm not saying your money's guaranteed to go up by 10% every year. You might have years where you go up by 20%, 25%. You might have years where you lose 11%. But over that 10-year period and over a 100-year period, it is shown to consistently return upwards of 10%. So jump on Google, start looking at the S&P 500, you start looking at the price, and all of a sudden, you're going to realize the current price is over $6,000. Now, what if you're not ready to go that far into this, or you might not even have enough spare cash to go in with $6,000? Well, that's where something called an ETF comes in, an exchange traded fund. An exchange traded fund, or specifically one for the S&P 500, would be something with a ticker symbol. A ticker symbol is just the letters you type in to get the names of the stocks on the market. So, like if we look at IVV, done by BlackRock, it essentially mirrors the S&P 500, but it's broken down into smaller pieces, so you can get into the market for probably, I think it's $500 or a little bit more per share. Now, sorry, not $500 per share. When you're using certain brokerage companies in America, you have to buy in at a minimum of $500, but I think at the moment, IVV is worth about $69 per share. So the reason you want to use these ETFs, these exchange traded funds, there's many different exchange traded funds. They just take a group of businesses. So if you wanted, you could get an ETF for the fuel sector, the mining sector, the nutrition sector, the hospital sector. They just take a group of businesses and they make this group. So for instance, the S&P 500 ETF, you're buying a tiny little slice of 500 businesses. So if you think about it, if there was risk involved, you're mitigating it over 500 different companies. So if you put $1,000 in, it's not all invested in one company. Your risk is spread over 500 companies, and the odds of those 500 top American companies going bust is, well, if that happens, let's just say we've got bigger problems than the stock market. So the reason you want to use an ETF is obviously that boundary to entry is going to be less because we don't need the $6,000. We only need $500 or less depending on your brokerage company. The low cost management fees. Because all this does is mirror the market, there's not a person sitting there going, let's trade this and this and this. No, it's simply tracking the market and what these 500 companies are doing. So the management fees bugger all. And this is how we get essentially passive income. That's where you put some money in, you don't touch it, you forget about it, you don't do anything, and eventually over time it goes up. So it's passive investing. You don't have to do anything, you don't need to trade stocks, you don't need to be watching the screen or anything like that. But let's take a look at a real-time strategy. Let's say Dilly has $500 a month that he can put in. Now, if we compound this growth with our 10% return a year, over 25 years, right, we're going to come to a sum of $650,000. Only 150 of that, 150 grand, is your own invested money. The rest of that is growth from compounding interest and pouring the dividend back into the stock. Now, what is a dividend? Dividend is like a little slice of the pie that all these companies go, well, thanks for owning our stock, here's a little bit back each year. So yeah, you reinvest that, and plus the compounding growth, your money's going to go through the roof.
Today's video is brought to you by me. That's right, I don't have any sponsors. But hey, if you'd like to drop me even as much as $1 so that I can enjoy a cup of coffee, I'd highly appreciate that. So you can find the link down below in the description to buy me a coffee.
But in just 5 more years, this money, the 650 grand, would be worth over $1 million. Now maybe 30 years is too slow for you. Maybe you say, look man, I don't have that kind of time. We need to make this happen quicker. Well, it's all right. I've got you. We can do this. Essentially, the main lever we'd need to pull if we're going to back the time off is pull the lever of turning up the amount of money that we were to invest. So let's take that $500 a month. Let's crank it up. Let's run it to $500 a week. Now, to get back around to that $600,000, it's only going to take you 12 years. Now, essentially, a lot more of that money would be your own invested money, not the compounding interest making that effect. But 12 years to get to 600 grand. You add another 4 years on top of that, and that's going to bring you to $1 million. So from today, you could essentially be a millionaire in 16 years or less if you just stuck to this strategy and just crank that money in. Now, if you guys are getting anything out of this video, please do feel free to like, subscribe, and comment. Tell me down below, are you in the market? Are you looking at getting in the market? Tell me what's holding you back from getting in the market. But if you are in the market, what stocks are you buying and why? Let me know down below. I want to talk about this. All right. Thank you once again for taking the time out of your day to watch this video, and I'll see you guys in the next one.